Here's a summary of Union Pacific's UNP 2025 Q3 earnings call, designed for clear and concise delivery. Introduction and CEO's opening. Good morning, everyone. Today, we're reviewing Union Pacific's strong third quarter 2025 results, which are a testament to our focused strategy and execution. We're seeing proof that we are successfully driving improvements and pursuing what's possible. Key financial metrics and performance highlights: earnings per share. EPS reported EPS was $3.01. Excluding $41 million in merger-related costs, adjusted EPS was $3.08, a 12% increase year-over-year. Revenue. Total operating revenue reached $6.2 billion, up 3% from last year. Freight revenue, excluding fuel, also grew 3% to $5.9 billion, marking its sixth consecutive quarter of growth and a new best-ever record. Operational excellence. The company achieved several best-ever quarterly records, including workforce productivity, fuel consumption, terminal dwell, and train length. Operating ratio. The adjusted operating ratio improved significantly to 58.5%, a 180 basis point improvement compared to last year. Safety and service. Safety and service results also showed improvement, underscoring the team's commitment to running the safest and most reliable railroad. Cash flow. Third quarter cash from operations was strong at $7.1 billion, up 6%. Debt reduction. The company prioritized debt reduction, paying down $1 billion in long-term notes, bringing the adjusted debt-to-EBITDA ratio down to 2.6x. Share repurchases remain paused due to the merger. Segment performance. Bulk revenue increased 7% on a 7% volume increase, driven by strong coal demand and increased potash shipments, offsetting lower domestic grain demand. Industrial revenue grew 3% on a 3% volume increase, with strength in petrochemicals, construction, and metal shipments. Energy and specialized markets remain challenged. Premium revenue declined 2% with a 5% volume decrease, primarily due to lower international intermodal volumes, down 17%. However, domestic intermodal delivered record volumes. Automotive volumes were impacted by reduced production and quality holds. Management's forecasts and future outlook. Fourth quarter 2025. Volumes are currently tracking down 6%, largely due to tough comparisons in international intermodal. Merger costs and paused share repurchases present headwinds. Despite this, the company expects to achieve its three-year EPS CAGR target of high single to low double-digit growth. Long-term, the company reaffirms its view on accretive pricing, industry-leading operating ratio, and return on invested capital. Merger with Norfolk Southern. Filing of the merger application with the STB is expected within the next few weeks, potentially by the end of November or early December. The company is in discussions with other unions to formalize job guarantees for unionized employees. Significant shipper support has been demonstrated, with over 400 letters of support received. Significant risk factors: macroeconomic environment, softer automotive sales, and housing starts are impacting volumes, presenting a challenging backdrop for the close of 2025. Merger integration. The complex regulatory approval process with the STB and potential opposition from other railroads are factors to manage. Competition. Increased collaboration among competitors post-merger announcement highlights the competitive landscape. International intermodal volumes. Tough year-over-year comparisons are impacting this segment. Key statements from management. Jim Vena, Chief Executive Officer. Our third quarter results serve as proof that we are successfully executing on our strategy. We are focused on driving continued improvements in our pursuit of what's possible. The entire team has delivered at levels of service close to 100%. We will have more American jobs and more people working for Union Pacific, the combined company. We are confident in our ability to lead the industry in safety, service, and operational excellence. It's not one person, it's the entire team that delivers. Jennifer Hammond, Chief Financial Officer. Overall, really great quarterly financial results enabled by successfully executing on our strategic priorities. We have paused our share repurchase program. We are prioritizing the reduction of debt and paid down $1 billion in long-term notes during the third quarter. As we close out 2025, we expect our cash balance to steadily grow with our strong cash generation. Volumes are currently running down 6%. This level of decline, plus merger costs and paused share repurchases, obviously creates a headwind to earnings and margin expansion compared to last year's record fourth quarter. The railroad is running extremely sound fundamentally, and that will absolutely continue in the fourth quarter. Lowlights: slightly negative volume growth in the third quarter, particularly in international intermodal. Softer macroeconomic indicators like automotive sales and housing starts. Merger-related costs continue to impact reported earnings. In summary, Union Pacific delivered a strong third quarter of 2025, driven by significant operational improvements, core pricing gains, and excellent service execution. While facing some macroeconomic headwinds and the complexities of the proposed merger, the company is demonstrating its ability to enhance efficiency and profitability. Management remains confident in their strategy and the long-term value proposition of the Union Pacific franchise, particularly in the context of the proposed merger with Norfolk Southern.